Investment principles, or to delve to it much better, principles in doing business, is about understanding the realities of the business world and knowing how to play your game well to get the most returns from it. So the list of investment principles here are what I gave a glimpse earlier, which is given by the investor Ray Dalio. And these include 1. The theoretical value should equals the present value of future cash flow. This means every investment is a lump sum payment for future cash flows. In other words, let me say, an investment goes like a single payment done at a single time, bullet payment, to receive a future value which we expect much returns or to be higher. So whenever we think of something like, is an investment worth it? Firstly, we look at the projected cash flows, then we discount it with the inflationary rate. This gives us the theoretical value, which is what we actually call our returns. The second principle, the actual value that an investment will trade at should equal the total amount of spending. If you calculate the total amount of money spent divided by the quantity of goods, you will get your real actual value per unit. So in investment, always go by the looking, how much is it going to be spent? What are the motivations of other spenders or investors? Since smart money is always competing, everybody like it. And how much of it is it going to be quantitative attractive to push in? In doing business, always estimate your entire spending, not like the unit you bought on a commodity to sell, and divide it by the total quantity available to know your real returns or profit per commodity. In this real world, the business which gives the greatest profit is the business which goes like betting on productivity. This is why always investments in stocks always look very attractive, but their flaws are severe. And you can see Forex, Bitcoin, and those trading markets makes a lot of money since it's just about betting on productivity on currencies. And the one which follows next, or the next business which gives much profit, is the one which is all about taking money from people. Yeah, those who have the most money are those who have taken a lot from people. That's the reality, regardless whether it is legit or illegally. So not to go far, even if you do a retail business, you are taking money from several people's pockets. That's why the net worth of the top 10% is almost equal to the base 90%. So the business that follows next thereafter are those who take money from the ground, the miners, and so on. Let's go to our principles. The third principle goes like, asset class will always outperform cash over long term. And this is very necessary because or else the economy wheels would grind to standstill. But asset class outperformance over cash cannot be like very positive for too long. If it was so, then everybody would go and borrow money and buy the long-term items and make a lot of money out of it. No, they don't just simply work that way. They always comes with big bumps along the way. And that's why always it is priced to discount future expectations. So you can see inflationary growth, risk premium, discount rates, and others are always included. The fourth principle, every investment is a return stream. So every day you can market to the market. So for investors, they should be able to put together portfolios of several return streams, and most importantly, balance them well. Ray Dalio always states, his success always comes with knowing how to deal with his not knowing. Because no matter who you are, what you don't know would be a lot than what you actually know. Number 5, diversification can reduce your risk more than it reduces return. Although there are several schools of thought like put all your eggs in one basket and watch them carefully, Andrew Carnegie's principle. But with investment, it goes like the vice versa. Diversify. Don't put all your eggs in one basket. Always higher risk goes with greater rewards, but the best way to reduce your risk more than you could reduce your return is by knowing how to diversify well. Return streams evaluation can be divided into two categories. These are the alpha evaluation return stream, and the beta. Alpha reveals how a stock has performed in comparison to its peer stocks or the market as a whole, whilst beta just measures the volatility of an investment, the level of risk associated with an investment. So it goes like the speedometer of a car, the one which checks the engine temperature and the one which checks the speed level. So there is always an intrinsic reason for an asset class to perform in a specific manner, which you should always be aware of. For example, if you have growth exceed discounted growth and interest rates don't rise much, you should automatically be aware that the stocks would go up since credit is cheap, so people will borrow more money to buy more stocks. A high alpha is always good, whereas a high beta may be preferred by investor who into growth stocks, more higher net worth, but may be shunned by an investor who seeks steady returns and lower risk to protect his business or his equity. Number 6, the key to good investing is to create good portfolio of good return streams. Diversification naturally appeals to the risk-averse creature inside every investor. Betting all your money on just one horse seems riskier than spreading out your bets on maybe different 5 horses, which could be much better. But how do you choose those horses? You can use just your intuition and maybe randomly pick any 5, but that would be like just gambling or playing a game of chance. So professional fund managers don't rely merely on just intuition for picking just a well-diversified portfolio. They go by using statistical techniques for finding the good investments or finding what are actually correlated assets and uncorrelated assets. When 2 or more assets moves in the same direction and at the same time, they are considered as positively correlated correlation, so maybe like +1. And when an asset tends to move up and the other moves down, then they are considered to be negatively correlated or uncorrelated assets. So it goes by negative, maybe -1. And if it's equal to 0, that means the stocks are uncorrelated or their movements are independent on each other. For instance, if you invest in 2 different real estate companies, then you've gone for a correlated investment. But mind you, when the real estate market is down, all companies related to real estate goes down, irrespective of the company. So here, you haven't actually diversified your portfolio. You just bought the same thing. But if you invest in equities in companies with completely different field of operation, then this is what we call a well-diversified portfolio. For instance, investing in maybe a company in pharmaceutical side may come with steady returns since the rate at which people consume medicine always remains the same. So their volatility is relatively lower. But when you are investing in companies dealing with Bitcoin, it comes with greater returns but higher volatility. This means these 2 companies are negatively correlated or uncorrelated. So there is a real diversification taking place. Next principle, systemizing decision rules is critical, and those rules should be timeless and universal at all points. What I mean here is, we write down the criteria for investing and then we take note of those. Some of these criteria include diversification, as I recently talked about, investing well, knowing the right stocks to buy. People always tend to buy stocks that are already up and consider them as good investments. No, they are expensive. They've already done well. We buy stocks that are moving up or have greater probability of going up. So always, you have to execute a game plan, a well game plan. The markets are very different than just consensus decision making. It's a counter consensus. You have to know what you are really doing. The process of ambiguity and maybe doubtfulness is always built into the price as well. So if everyone loves something, then you must note it's expensive. And if everybody hates something, then it is cheap. So always people go by the look like. They want a great company. They want Amazon. But who doesn't know Amazon is a great company? So since everybody wants Amazon, it becomes increments and less great than we think it is anticipated. Have great humility about what you don't know. Try develop some instincts like if you are super sure or extremely excited and you are going alone, then it's very risky. You should be scared. If you are doing something you are really worried and nobody else is doing, but you are sure it's right, do it anyway. You shouldn't be dissuaded. So by forcing ourselves to derive such rules or principles for ourselves should be timeless and universal, and it becomes the standard by which we operate by.